amounts of pension expense. So the employer needs to determine how much they will record at pension expense for a specific year, and there are several components that affect the pension expense. For example, the most important part of determining pension expense is the service cost. So service cost is the expense caused by the increase in the pension benefits payable or projected benefit obligations to employees because of their current year service. So these actuaries actually determine based on different formulas, and then they take the present value of those future benefits based on the employee's current year service, and that also increase that year's pension expense. And we all know that projected benefit obligation is a liability. It's a long-term liability. Basically, pension is a deferred compensation, and since it's a future liability, it's future obligation, so we also need to calculate the interest expense, and that interest expense is based on a rate that actuary also helps to calculate and determine. We call it settlement rate. Interest expense also increases the pension expense. And for this chapter, you don't need to calculate any present value using any present value factor. All numbers will be given. Interest rate, service cost, all will be given. So interest is basically your amount or balance of your PBO and multiplying by the interest rate estimated by the actuary. And then we will also see the return on plan assets. So this return on plan asset is the return that the plan makes from the investment of those money or fund. Usually those are invested in a stock market, bond, or any other security. So if there is any gain or dividend, that will increase the return. On the other hand, if there is any loss, that will decrease the return. Also, any changes in the fair values of the fund assets will also be a part of this return of the plan asset. Then amortization of prior service costs. Sometimes there might be some amendments, or there might be some new inclusion or initiation of a pension plan, and then the employer needs to give benefits based on the employee's prior year service. So those prior year service cost will be amortized over the future year service. So that will be also a part of pension expense. And you will see there might be some other factors that can result in some unexpected gain or losses in the plan asset or pension projected benefit obligations, and that will also impact on your pension expense. So next slide will summarize all those factors that determine the pension expense, and which factor increases the expense, which factor decreases the expense. For example, of course, service cost will increase pension expense. It's based on the employee's current year services. Interest is simple interest expense based on the amount of PBO or liabilities. And actual return, so this is basically a return, and it will decrease your pension expense unless you have any loss related to the fair value changes. And then this is amortization cost of your prior year service if there is any initiation or amendment of the pension plan. And then this gain or loss is sudden unexpected gain or loss. Depending on is it a gain or loss, the pension expense will increase or decrease. Now we will learn a more detail about some other concepts of those cost components. So service cost, we actually discussed it. This is just because of the employee's current year service. Actuaries will use the formula and determine that amount and take the present value. And interest, we also discussed it. This is interest on your PBO outstanding or future liabilities, and return on plan assets. So return on plan assets, of course, we know that the return are made from all those dividend incomes or gain or losses from there where those funds are invested, such as in stock, bonds, or other securities. But there are some other factors that will also impact on the return on plan assets. So for example, employer contribution. So every year employer will contribute, and that will increase your plan asset, and then you have that regular return from those plan asset investment. And then every year employer will also pay some benefits to their retired employees that will decrease the plan assets. So if you are asked to calculate the return on plan assets, so first you will check the changes in the balance. For example, plan assets ending balance minus the plan assets beginning balance, and then we will subtract the contribution made by the employees that period. Because this is the new contribution, this will not reflect the actual return, and then we will add back the benefits that the employer is paying to the retired employees. So this is how we will calculate the actual return. Now we will see one quick example how to calculate the actual return on plan assets. So if you look at the balances of the plan asset, the beginning of the year versus at the end of the year, it might have different components. It might have the returns that are made from the investments in bonds, stocks, or other securities, or it may also include the contributions made by the employer that year, or the benefits paid by the employer to their retired employees. So let's see this example. Munox Incorporation had the following data. Fair value of the plan asset at the beginning of the year is 4.2 million, and the fair value of the plan asset at the end of the year is 5 million. So from here you will find the changes in the plan asset. So the changes in the plan asset is 800,000, but it's not the actual return. So to know the actual return, what we will do, we will subtract contribution or the money or cash that paid by the employer that year. So we subtracted that contribution, 500,000, and then we will add back the benefits to know the actual return on plan assets. So the benefits paid during the year is 300,000. If you add that, we get that the actual return on plan asset for this example is 600,000. Now we will see a little extended illustration. Mayhew Incorporation has the following information. Beginning balance of their plan asset, ending balance of their plan assets is all the fair values, and contribution made by the employer that year, 280,000, benefits paid by the employers to their retirees or retired employees, 350,000. So by using for first four numbers, you can calculate the actual return on plan assets. Now we also need to calculate, in addition to actual return, we also need to calculate the total pension expense and fund status. So if you remember in earlier slides, the pension expense has several components. Of course, return on plan asset is one of the component. You also have service cost, and you also have interest, so we will include those. And then we will see that what is the fund condition. That means after incorporating everything, we will check what is the amount of projected benefit obligation or the amount of the liability or PBO versus the fair value of the plan assets. That means the liability versus asset. Then you can say whether it is overfunded or underfunded. So we will know the status of the fund by this way. Now let's see how we will solve it. First, for calculating the actual return, we take the differences between the beginning and ending fair values of the plan assets. This is just showing 325,000 is just showing the changes or increase in the fair value of plan asset. Then we subtract the contribution, because contribution is just made by the employer to the plan asset that year, so it does not reflect the actual return, so we subtract it. And then we add back the benefits, because benefit is paid by the employer to the retirees or retired employees. So it actually, in one way, it actually understate the return. So to know the actual return, we add it back, and we found the actual return on the plan asset for this year is 395,000. Now when you have to calculate the pension expense, so remember it's an expense, so we will see everything from cost or expenses point of view. So we have service cost, it's given in the problem, and you have interest, it's also an expense. Now we add this, remember it's pension expense, so we will subtract our return. So to know the pension expense, we added service cost, interest, and we subtract the return, because it's a return, but we need to know the net pension expense. Of course, it's a component of the expense. So for this year, the company's pension expense is 52,000. Now the simple task is to check the fund status of that plan. So for fund status, everything is given. The ending balance of PBO or projected benefit obligation is 2.737 million, which is a liability, and then fair value of the plan asset, which is 2.725 million. So if we compare this obligation or liability versus the asset, so we see here that PBO amount is higher. PB or liability is greater than the fair value of the asset, and the difference is 12,000. Since the liability part is higher, we will call it first it's underfunded, and the company will show it on their balance sheet as pension liabilities, of course on the liability part.